Saturday, September 5th, 2020, Monaco 64, home of alternative economics and contrarian views. Today I will talk about how Bank of England inflation will ravage the pound and what you might be able to do about it to protect your savings if you're in the UK. This also applies to everyone around the world, but I'm going to focus on the Bank of England because that's where I am in the UK. So many people think of inflation as the CPI, but the classical definition of inflation, before we go on, is the creation of excessive money and credit. So let's go through the growth of the Bank of England balance sheet, or the assets it has on the balance sheet. You've probably heard about QE, quantitative easing, right? Well, that's how they increase their balance sheet. Where they get the reserves or the money from? Well, out of thin air. So just to give you some perspective, at the rate that the Bank of England balance sheet is growing nowadays, we're going to reach £1 trillion. Their balance sheet, the Bank of England balance sheet, will reach £1 trillion by November 16th. And this is accelerating now, and that's why I'm saying they're going to ravage the British pound. It has been a gradual process. The analogy of the boiling frog comes to mind, of course. I think we're reaching a point where the frog is going to feel like it's boiling to death. And that's what I think is happening to the British pound. People are going to realize that the British pound is being ravaged and they're going to try to get away from it. And I'll come to how you might be able to protect yourself, of course, towards the end. So to give you an example, on March 25th this year, the Bank of England's balance sheet was at £586.81 billion. And the latest figures from the Bank of England as of September 2nd, the balance sheet is now at $868.66 billion. So that's an annualized growth of 108.5%. The real growth over the last 162 days, well, that's a 162-day period there, is 48.22%. So that means the Bank of England is creating 1.74 billion pounds per day, right? So I've calculated, it's simple maths. At this rate, the BOE will have reached £1 trillion or 1,000 billion in assets by November 16th, 2020. Just wanted to give you some perspective. If you look at the Bank of England assets in 2008, they totaled 72 billion or 4.5% of GDP or gross domestic product. So we've gone from 4.5% to now 50% of GDP. As you can see here, the UK national debt topped 2 trillion this year and surpasses 100% of GDP. So our GDP is around 2 trillion. The Bank of England should have about 50% equivalent of the UK economy in assets. And that's gone from 4.5% in 2008. Of course, 2008 was a really important year, the financial crisis, right? And I don't think it's going to get better. Some people might argue, well, the QE, the money printing, is going into financial assets, financial markets. But I would argue that now it's seeping into the money supply, M1. As you can see here, M1 has grown by 10.24% in 4 months. That's around 30% annualized. As you can see here by the chart, how it's accelerated since March. And then you have M2 as well, which is, of course, M1 plus short-term time deposits in banks. That's growing very quickly as well. It's accelerating. So basically 50% of the country is mortgaged to the Bank of England. This proportion or percentage will almost probably increase as state support for businesses and individuals unwind these next few months into the end of 2020. We've all heard about all the furlough schemes ending, all the support for businesses ending, right? Even the Bank of England is warning us that the economy is most probably not out of the woods and that more monetary stimulus will be necessary. So there you go. Bank of England could unleash more stimulus if recovery falters. An extra quantitative easing would come on top of the 100 billion unleashed last month, and that's on top of the 200 billion they unleashed just after lockdown, right? So they're up to 300 billion already this year. They're talking about another 100 billion. And this is according to MPC member Michael Saunders. Well, what's the MPC? It's the Monetary Policy Committee of the Bank of England. So this is from the Telegraph, this article. This is not me saying this. The Bank of England, as you can see, doesn't have much room in terms of interest rates. Their base rate is at 0.1%. So their excuse is that they'll have to just print the money and call it, of course, quantitative easing. But all that will mean is that more and more of the UK economy is going to be mortgaged to the Bank of England. So this is what is really happening, in my opinion. You might not agree with me, but the effect on your savings will be the same. So the chances of the bankers via the Bank of England taking over the country will increase substantially as the crisis is used to undermine economic activity and destroy the purchasing power of the currency, aka the British pound. This combination of shrinking economic activity and the debasement of people's savings will mortgage the economy even more and make millions dependent on the state and the bank, ultimately, because it's the Bank of England that's financing all this. In our opinion, moving a proportion of one's savings from the national currency to gold and silver is one way to maintain the purchasing power of one's savings and some inkling of sovereignty. So this is not a recommendation. This is what I think and what I've been doing since 2002. The Bank of England has only got the tool of the printing press or quantitative easing. And as we have seen, that is leading to an increase in M1 and M2 money supply while economic activity remains at a fraction of where it should be. The consequence of that will be too much money chasing too few goods, and also investors running towards tangible assets as the bank continues to create money out of thin air. So as Alan Greenspan, the former chairman of the Federal Reserve Board or Federal Reserve Bank, once said, and I quote, "In the absence of the gold standard, there is no way to protect savings from confiscation through inflation. There is no safe store of value." Of course, there are other ways to store your savings through tangible goods, through real estate property. But here I'm just focusing on the monetary savings aspect. So many people say, well, the gold standard was a disaster. It led to the Great Depression. Well, I would argue differently, but the point of this video is to prove that the gold standard was a period of stable prices and no inflation at all. And I've got data here from the Bank of England. So the Bank of England inflation calculator. So the first calculation here on the left is what would goods and services costing £1 in 1821 cost in 1914. Why those years? Well, 1821 is when Britain went back on the gold standard after the suspension from 1797 for the Napoleonic Wars. In 1914, of course, was the year that Britain left the gold standard because of World War I. Yes, we went back in the late 20s, early 30s to some kind of gold or bullion standard, but for all intents and purposes, we left the classical gold standard in 1914. So you can see here, it looks like the pound went down because it says 0.95 pounds or 95p. Well, that means that you only needed 95p to buy what cost a pound in 1821, in 1914. So inflation average, as you can see here, minus 0.1% a year. So there was a slight deflation of minus 0.1%. And we're told today that deflation is a problem, right? But I don't think it was a problem during the Victorian era. I think this country did quite well during that period. And why did the gold standard help that? Well, because the gold standard attaches the currency to gold. And even today, legally, the pound is one gold sovereign. So prior to World War I, if you went to the Bank of England, and that's all the way back to 1821, from 1821 to 1914, you could go to the Bank of England or another bank and present them with a £5 note like this, right? Bank of England £5 note. And they would pay you 5 of these, 5 sovereigns, right? Here you go, 5 sovereigns. 1, 2, 3, 4, 5. So I'd go to the cashier, present that, and they'll give me £5. And that never changed from 1821 to 1914. So that's why there was no inflation. So we left the gold standard. So what that meant is the bankers could issue more and more of these without the backing of these. So it's the simple law of supply and demand. And that's why these pieces of paper buy less and less, because gold has been a store of value for thousands of years. It's not there to make you rich, but it's to maintain the value of your savings, right? Is it any wonder that these pieces of paper, of course they're smaller now, are buying a lot less in the shops, and that these are becoming more and more valuable? It's not that gold and silver are going up in value, it's that there's too many of these. So as I said, the simple law of supply and demand. So now let's look at the, since Britain left the gold standard in 1914, so now you need 116.26 pounds to buy the equivalent of £1 worth of goods in 1914. It's a no-brainer, really, and you can see why Alan Greenspan was right about gold and the gold standard. I just wanted to show you, compare the Ftse 100 index and gold, or XAU GBP, because gold is traded as a currency. So that's the symbol for the price of gold in British pounds, XAU GBP. And this is since 1995. You can see that the Ftse has really gone sideways. It's had a lot of ups and downs. The price of gold was very stable, I would say, up until 2000. Didn't really go anywhere, but it's been going up, or the pound has been going down since then. And it's not just the British pound, of course, it's all major national currencies that have been losing ground versus gold since 2001. You can see there, on average, they've lost 10% a year. That's because all the central banks and governments of the world are printing money. Why do I say governments? Well, because it's the governments that give central banks the monopoly power to operate. I told you at the beginning of the video that I would give you my opinion on how to protect yourself from this Bank of England inflation. Well, many of our viewers have asked about gold and silver and how to buy them. I've been making these videos since 2015, and I've been saying the same thing since then. I didn't expect all the money printing from 2008 onwards to be able to be reversed, and I expected it to continue even more. So our recommendations for people to shop around and try to get the best deal, but trust is also very important. And I also think that some people have never bought gold and silver, and they need some advice. So we have dealt with gold investments since 2002, and they are arguably one of the oldest family-run full-service bullion dealers in the city of London. So if you've never bought gold and silver before, give Oliver or Simon a call, and they will be happy to help. And do not forget to give them our promo code, which is Monaco64. I started dealing with gold investments back in 2002 with Mike Temple, who's Oliver and Simon's dad. So I know them very well and I trust them. But as I said, do your homework. I'm not telling you you should deal with them, but I think trust is important as well. So there you go, gold investments. You get a small discount when you buy precious metals from them, and all the details are below in the description of this video. So there you go. Yes, don't be fooled by the talk of low inflation. The Bank of England is creating massive inflation, and the impact of that on your savings, if you hold savings in the national currency, is going to be tremendous. I think it's going to be very detrimental. And I know not many people are talking about these things. And I know there are a lot of distractions out there. And hopefully I've been able to shine a light on a subject that you might not have thought about. So if you enjoyed this video, please hit the like button. Make sure you share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Facebook, and all these other platforms below here. I wish you all a great weekend. Take care. Bye.